Hey everybody, Patrick Ray here, CEO, co-founder of CanopyBoulder, and I would like to welcome you to a cannabis capital and fundraising overview webinar. Our objectives today are to help you understand the reality on the ground in raising capital in the industry, to understand who the investors are, where they are going, when they're investing, why they're investing, how to get your maximum valuation and to close the deal. This is a abbreviation of a number of sessions that we'll run during our program at CanopyBoulder, which we are now accepting applications for. And let me tell you a little bit about the CanopyBoulder really quickly before we get started. So CanopyBoulder is a venture capital firm with a business accelerator. We've raised 7 funds over the years, over 15 million now raised from 100+ investors. We made over 130 investments in 100 companies, and those companies have gone on to raise. Now this is well out of date. I think the number is closer to 100 million to serve over 20,000 customers with the help of 200+ expert mentors and advisors from inside and outside the cannabis industry. Our companies have created value well over 200 million now, and it's a real sight to see, honestly. We invest in ancillary products and services. Here are some examples of companies that we invest in, whether that's payroll processing, data, robots, packaging, but we're also now investing in CBD and hemp. And CBD and hemp, being from Boulder, Colorado, reminds us a lot of the natural foods, organic foods, and dietary supplement market. And that's a space where I actually worked for about 15 years. So we've got a good understanding of that market as well, and also a great network of mentors and advisors from the space who are able to help with the actual work of going to market for these products, as well as everything else that is involved. Great experts, great resources for the teams that join the CanopyBoulder Accelerator. Our team is very strong. Bob has been a startup CEO 7 times, I think it was actually. A couple of those were turnarounds, so he's been there, done that. Technology, hardware, and fintech in his background. Then Celia Daly, she's our head of investor relations and community relations, also does all the marketing. So Celia is in touch with a lot of the investors and a lot of the companies in our portfolio, essentially matching investors to portfolio companies. That's a big part of her job, is making those introductions. And a lot of the value that we bring to the table, I think, at CanopyBoulder. Some examples of companies that we've invested in across different categories. And we run a business accelerator program. So what is that? It's a 13-week full-time program in Boulder, Colorado. This is something that on a week, it'll average around 11 hours of scheduled time, education sessions, mentor sessions, pitch practice, one-on-one meetings, etc. We have a beautiful office in downtown Boulder. This is what it looks like. For us running mentor sessions in the bottom left-hand corner, and do a rapid fire investor and mentor matching there in the bottom right-hand corner. But it's a great space and a great town, and we do a lot to make the environment conducive to success for our teams. It's a mentorship-based program. So again, we don't become interim CEO, and neither do our mentors and advisors, but they provide a lot of value for the companies, again, inside and outside the industry expertise. And we have a structured program and a custom program. The structured program, it's designed around the cohort needs. Every team goes through this. This is the bulk of the 11 hours a week. Every week has a theme. One week it might be marketing, one week it might be sales. We'll have, for each of these weeks, we'll have recommended reading over the weekend, materials to review. We'll have mentor and education sessions during the week to highlight this topic, if it's marketing, sales, HR, venture finance, whatever. We will also have assignments that will help the entrepreneurs, you build up your due diligence packet and data room for raising capital or just moving forward with a strong foundation underneath you. Like I said, a theme curriculum every week's different, assignments and resources, mentor presentations. And at the end of the 13-week program, most of the teams are out looking to raise capital. Some certainly aren't, and we have different options for them. But if you're going out to raise capital, we will run investor previews and demo days to get you in front of the investors, whether that's in person, virtual, over email, or whatnot. We're inclined to help you raise more capital so you can do more faster and move forward more efficiently and effectively. A key thing for the program in the custom program is the weekly one-on-one meetings. So these are meetings with the CanopyBoulder staff, and we'll even bring in mentors, your mentors, to make sure we're working as a team towards the goal and the objectives that we've set even before the program. So a big part of our due diligence process is making sure we share the same vision and goals and objectives that you do, and that we can actually help, right? There's nothing worse than trying to be a active, helpful investor and not being able to move the needle for our teams. Our objective is to, for meetings and connections that would take you a week or a month, to get you a connection with that key person in a couple of days, right? To get feedback from potential customers might take you months. We want you to get feedback in a week, right? So we're just trying to accelerate everything that's going on with your business. We also host community events because we know it takes a village for our teams to have success. If you look in this picture, you're probably going to see some very well-known and familiar faces in the cannabis industry. Our pitch practice we do every week. It's Monday afternoon. It's a great thing to get out of the way. It's a big practice. It's a big lift to do and be ready and to stand up in front of your peers and mentors and staff on the CanopyBoulder side and pitch and get we play investor Q&A right after the pitch, usually 5-minute pitch. Then we go straight into investor Q&A. All the people in the room ask questions like they're an investor. And then we'll break and give feedback. Okay, typo here. I like that intro, or that way that you close on that slide didn't work for me, right? So it's a really high feedback process that I think really helps teams get ready. Last thing I want to mention is our partnership with the ArcView Group. If you are looking to raise capital in the industry, you want to go where the investors are, and with over 600 accredited investors who are paying dues to be part of the ArcView organization and the number of events that ArcView puts on every year, ArcView is the leading investor forum in the cannabis industry for early stage companies. If you need to connect with more investors, you don't already have a big Rolodex, ArcView Group is the way to go, and we've been partnered with them since our founding, and our teams get the right to pitch on stage and try out, and we utilize our time at the ArcView Group on stage to give our teams maximum exposure to investors, and you'll see a picture like that later. So what do we look for when we're assessing teams coming into the accelerator? Team. We're also interested in exit potential. If this is a business that's you're going to sell for $1 million in 10 years and we're going to invest $120,000 into it, it's probably not right for us, right? We're looking for big exits, a large target market opportunity. We're also looking for a business with good traction and good timing, right? It's very easy in the cannabis industry to think ahead and say, you know what, I think the industry is going to need this, and go for it. And you might be too soon and you miss on the timing. Traction is the best way to judge that you have the right timing. So we like to see teams who are generating some revenue and sort of turning the wheel of their business to see what happens when they start charging people and what they require, as opposed to having it all be theoretical. Competitive landscape is definitely something we think about as well, but not the most important thing. We always say there's room for better, but if you are going into a competitive space like point of sale or seed to sale or marketing engines for dispensary, you better have something that's really unique that you're bringing to the table, because if you don't have a good moat, something that's defending you from competitors that it's going to be hard to jump over, it's hard to imagine, it's harder to get on board with you to understand that you're going to win in that competitive space. We like intellectual property. We like, having an IP plan for each company. What are you going to develop that is yours and not anyone else's? And then finally, everybody needs to be disruptive, right? whether you're new or you're pioneering a new space, or you're going into one that's already pioneered. So today is the 22nd of October, Tuesday. Our application deadline for our next accelerator cohort, which will begin in January 13th in Boulder, Colorado. The deadline's October 25th. We are already in discussions and have reviewed hundreds of applications, but you know what? We know that there is always room for more. So we're excited to see your application. First step is request an application and complete that application when it's sent to you. If we like what we see, we'll ask to see for you to send over a pitch deck, which we'll do a review of as a team, and then we'll be in communication with you at every point. And we'll start our due diligence process. If after our team review, we like what's going on, we'll reach out to our investor community, our mentor community, the industry at large, to see if your product or your company is hitting on 6 key points. Can you crisply state the problem? Can you ID who has this problem? Is it top of mind for them? Is it a solution urgently needed? Will they pay to solve the problem, and does it work? That's really important for us. And if all those line up, we will definitely make you an offer. What we are offering is a $120,000 investment. It comes in 2 parts, modeled off the Techstars accelerator program, where we are investing $20K for around 6 to 9.5% common stock. So not preferred shares, and then we'll do a $100K convertible note with a $2.5 million valuation cap. So that is CanopyBoulder in a nutshell. Remember, the time to apply is now. We are in the process already in due diligence with about 15 teams. We'd like to add you to that mix if you are interested, and we think you're doing some interesting things. So now's the time. Okay, so let's get to the meat of the presentation here. We're going to talk about cannabis capital and do a bit of an overview there, right? So this presentation's going to be full of information. We're recording this to be viewed in the future, so don't feel like you have to screen capture all these slides or take crazy notes. So we're going to put it up online for you. Okay, so what are we covering? Who are the investors? What stages are they investing in? When is the time when to time your capital raise? How to get the best valuation to close the deal? So what's going on? We're in and out of periods of cannabis FOMO, right? I think at a high level, everybody knows this is going to be a big industry, but depending on the news of the day, stock valuation, who's the attorney general, and what was tweeted 30 minutes ago, FOMO goes in and out, right? The fear of missing out for the investors. So it's good to have an awareness of that and have some patience. Deal activity is up in cannabis, but the number of deals interestingly have trended down so far in 2019. We think they will continue to go up, but the access to seed stage capital or early stage capital has definitely been on the decline. More money is going into later stage deals. If you're an entrepreneur and you're seeing the news and press releases of these deals and you have feeling your own sense of missing out, I would encourage you to look down this list and think about how these companies are doing. Yes, it is a milestone to raise a lot of capital, but raising capital does not define success. It enables it. Execution is everything. Ideas are relatively worthless. Strong teams have the best opportunity to execute. But sometimes when you raise hundreds of millions of dollars at billion-dollar valuations and you don't execute, you just look like a startup that failed that raised a lot of money. So don't be afraid, and don't be fooled by the data. Interestingly enough, we at CanopyBoulder were so busy we're unable to contribute to the pitch book review. I think in this timeline we did maybe 25 deals. So there's a lot of capital out there, but it's definitely it's more so being selective and keying on the things that I mentioned before: traction, strong team, and execution. So what should you be thinking about when you're raising capital? Here's some rough guidelines. And these are guidelines to follow. They're best practices. They are quote unquote market standard. And there, it's important to not be exceptional in the wrong ways when you're going out to raise money. If you are raising money and it's only going to last you 4 months, a good, smart, experienced investor is going to ask you about that. If you are expecting to close that round in 1 month, a good investor is going to ask you about that. If you are posting and forecasting wild milestones, an investor is going to ask about that. And if you're not talking to investors, trying to identify the lead investor, an investor is going to ask about that, right? So just follow the market standard practices. And what you'll do is you'll eliminate some of the early opportunities for investors to say no. So who's investing? What is their objective, and does it align with your objectives? It's very important to utilize an advisor network to give you perspective on what you're doing, right? And that advisor network can help direct you to the right investors. Is it an angel, a family office? Should you be talking to a Canadian licensed producer? Every one of these investor groups has different objectives and different ways that they do business. You got to make sure you're meeting the investor market where you are and where they are, right? It doesn't make sense if you're a startup to try to go raise from a Canadian or from the public markets, right? That is probably a recipe for disaster, and we're seeing a lot of that happen out, real time in front of our eyes in the cannabis industry. Understanding accredited investors, like we always encourage our teams, even if they're doing friends and family rounds, to only raise from accredited investors. It's very important, and the reason why is that if your Uncle Jed or Uncle Mary, I'm sorry, Aunt Mary comes in and puts 50K into your business and then gets a divorce, and Uncle Jed is looking at the deal that Aunt Mary did with you and says, okay, well, we got to liquidate that. You're not accredited. That means the divorce attorney is probably going to file suit and try to get that money back. If you're raising from people who are not accredited investors, that can invalidate your entire round. So very risky move there. Happens all the time, but just, beware. A lot of folks want to go to family offices in the cannabis industry, primarily because they are the largest sources of capital. They can write the biggest checks typically, and they're not institutional, right? They're not married to SEC reporting. They don't have public companies, whether it's insurance companies or trusts or pension funds or whatnot, that are institutions that in their boilerplate language disallow them from investing in federally illegal businesses. So a lot of investors are family offices in the cannabis industry. Problem is they often move slow. They don't have necessarily the same time pressure that a VC might. They can make their decisions on their own time. So we encourage, our early stage companies to focus on angel investors to get their first rounds of capital. One of the reasons, again, why we partnered with the ArcView Group, this picture on the right here is from an ArcView Investor Forum in Chicago, where we have 10 minutes on the stage through our partnership with ArcView, and we make sure that our teams get up there and do their 30-second introductions at the beginning of the conference so they know, or the investors in the room can know who they are early. So we're always trying to give an advantage to our teams raising capital. Now, growth capital, venture capital, this is where a lot of entrepreneurs want to raise capital, but often they're raising it too soon from them. A lot of venture capital firms in the cannabis industry are focused on growth stage companies. What does that mean? That means that they have a product or a service in the market and they've made their initial sales, they've passed through that beta customer phase, and now they're trying to grow. And a lot of that money is going to sales, to marketing, right? To build up the customer base and essentially push this business to a point where it's going to eventually get to a cash flow positive situation and change the economics of the business completely. One of the pieces of advice that we give to entrepreneurs when they're trying to raise capital from investors in the cannabis industry is aim for the market standard. and also be aware of what the market standard is, what the market standard documents look like, what the market standard terms and conditions look like. Because if you get a term sheet from an investor, or you go out and try to raise capital in a way that is, again, exceptional in the wrong way, that's a sign, right? It's a good reason for investors to say no, or for you to say no to investors. One thing that we have been seeing a fair bit is investors that come from the hedge fund industry. They will come, find a team that they like. They will, okay, see, all right, you're raising $500,000. They'll go and say, we want to do your entire round and give you the 500K, and the entrepreneurs like jump for joy. And then they realize that once they have an investor who's taken an entire round, typically in investor documents, there is a right of the majority of the investors in a round to approve or not a subsequent fundraise. So if you don't hit your numbers, you don't get profitable with that fundraise. Sometimes those investors can nix a future fundraise, which I know sounds counterproductive, but again, hedge funds that have experience with distressed assets can cause distress and then make those businesses their assets. So heads up. All right, so everybody's interested in valuation and what the numbers are, right? So, and what each sector of the cannabis industry keys off of for setting valuation. So ancillary products and services, usually technology-focused businesses, certainly there's a range, right, from a media play to a SaaS play. But what we're seeing in ancillary are valuations that are tied to MRR, or monthly recurring revenue. So if you are an early stage company and you're making 10 to 20K a month from your customers, you're going to be getting a valuation somewhere between 1 and 5 million. We have a number of companies that are in this space, and that is exactly the valuations they are getting. And the companies that trip over 20K then a month, then they are able to get 5 to 10. And this is very stock and standard. I know there are metrics in technology and healthcare and consumer products elsewhere that people like to apply to the cannabis industry, but this is what we're seeing in live deals and closed deals. Now, licensed businesses that are touching the plant, we see valuations range dramatically from 1x last 12 months revenues to who knows what times your dream and or whatever you can get, right? And I know it's crazy, but that is the world we are in. 2 examples, Medicine Man. Medicine Man Technologies is one of the pioneers in the Colorado cannabis market, retail, cultivation. They just went public and are starting to roll up Colorado licensed businesses. They're paying 1 to 2 times revenues. And that is a simple deal. That is market standard out in Colorado. And compared to the metrics and comps that are being driven by the Canadian LPs, it's much lower, but they're making it happen where you've got sexy deals, Canopy Growth and Acreage Holdings putting together complex deals that are hard to unpack and understand at astronomical valuations. And most likely as the stock prices come down, those deals are going to be underwater anyway. In hemp, and specifically hemp and CBD brands, we like to comp to natural and organic product valuations. So if you have a hemp and CBD brand and you're not profitable yet, but you're growing rapidly, you're on that growth curve in the growth stage of the business, you're going to look at 3 to 5 times revenues. Now, I know in the Canadian licensed producer market, you're seeing 100 times revenue multiples. You know what? Usually they're tied to stock, and there's a lot of risk there. So they're trying to compensate for buying, you as an entrepreneur receiving compensation for your business in stock. So they will push up those multiples, but that's what we're seeing. And then, we talk about new sources of capital. One to look at is crowdfunding. So a number of our companies at CanopyBoulder have raised money through crowdfunding. This isn't Indiegogo, it's not Kickstarter, they don't take cannabis, but Seed Invest, Republic, and micro ventures do. And we've had companies that have raised millions of dollars on these platforms, companies that have raised hundreds of thousands of dollars on these platforms. If you go to micro ventures now, you can go look at the Backyard Sodas deal, unless they've closed out their raise, and see what that's like. They've been a great way to get for consumer products to raise capital, but even B2B services as well. So let's talk about valuation a little bit more. As an early stage company, there's a lot of ways to come up with a valuation. The most important thing is to start the conversation with the investor. Make sure that you are moving, you're very communicative, and that when you say that you're worth something, you've done the work behind it to justify it. Just saying, well, one of my advisors thought we were this, isn't going to cut it. It's an easy way for a VC to shred you to bits, honestly. So make sure that you are using some of the methods we've outlined here, but at the end of the day, what you are worth is what someone is willing to pay at a point in time for a specific thing. So let's talk a little bit about these methodologies. And there's a lot of resources online for you to go in, dig in. The VC method typically uses a revenue projection for year 6, multiply it by 2, and then divide it by 20, which is the return on investment multiple that a VC fund is want to get, right? They're happy with 10x, but they're going to aim for 20x. So the formula is pretty simple. If in year 6 you're planning to do $25 million in sales, you multiply that by 2 divided by 20, and that gives you the post-money value of your business. So that's one way to come at valuation. Another way to come at valuation is through the scorecard method. So this is where you do sort of a weighting of different criteria and then assigning a value to that, giving you a score, which allows you to, the average value of a startup is going to be 2 million. So it allows you to calculate your score and then multiply by that $2 million average valuation to see if you are above or below the market average. Good to have your advisors do this exercise independently of you, so that you're not deluding yourself with your own bias about the greatness of your company. Another way is the Berkus method. This is where you assign value to the different stages of your business. I've included a link to a great blog from the Angel Capital Association on how to do this for you to dig in after. But the most important thing is when you're raising capital, I think one of the most important things is to understand the motivations and of different investor types, and make sure that you are aware, right? And understanding of what their objectives and goals are, and make sure they line up with you. And it's also understand their fears, right? And then how you should pitch them. If you're missing out, you're going to get a strong internal rate of return, you're going to beat the market, or it's going to be an income stream, right? So these different types of funds or investors want different things. So who are they? So what I've tried to do here is just like essentially back the envelope, list out a bunch of the investors in the industry who are active. And these are not funds who are, I call them phantom funds or vapor funds, who have a website and a press release but haven't raised money. Some of them are still raising money into their funds. The public markets and performance of the public markets in Canada have made it a little bit harder for many of the venture capital funds in the industry to close deals. I just heard about another one this morning. The deal was the 11th hour. The investor backed out because they were essentially unable to raise the capital they needed to fund that deal. It's really disappointing, and it's always a good reminder that you as an entrepreneur need to ask and get confirmation, and continue to ask and get confirmation in a very nice way that the investment fund has the money in the bank to make this investment. Or are they going to cut the deal, get the term sheet, negotiate terms, then go out and raise it? Obviously, if that's the case, the latter is the case, it's going to add a lot of risk to your process, and it would be not wise to get into an exclusive if they don't have the capital at hand. The other thing is, this thing called an IRR, internal rate of return, and we've got a sample fund waterfall for an investment firm, a VC, that's going to put in $1 million in 2 chunks, and they're nothing's, as an investment, and for 5 years, through to the year 7 of the fund, nothing's going to happen, and then they're going to start seeing returns, right? And that's how they're calculating IRR. If you want to understand how venture capital firms, hedge funds, private equity firms are measured, understand internal rate of return and do the math for the investment that you're raising for based on what you think your company will achieve and be valued at in the future, to figure out if this is a great deal for an investor. And just again, put yourself into their shoes, understand their motivations and their goals, and then you can align and have a great partnership or not. So how do you close a deal? Well, I always think that when you are pitching to an investor, you meet an investor, you got to get on the follow-up, right? Do it now. Operate in real time. There's a lot of tools here that can help you follow up and set meetings and keep the momentum. Look, in many ways, it's business development. In many ways, fundraising is sales. You have a hot lead. You want to keep it hot and close it. The other thing is, make sure you're communicating to these investors. Investors don't, it's very unlikely you're going to meet an investor. You're going to give them the pitch. They're going to say, we're in, shake hands. They'll go out, sign docs, and wire funds before you even get back to your office. That just doesn't happen. So what you want to do is you want to show good entrepreneurial behavior and have great investor communication. So this is what we recommend for our portfolio companies to use as an outline to communicate with investors. But when you're trying to close a deal, you got to find a lead investor. And those of you who have raised capital before will understand this photo. Sometimes it feels like you're hunting unicorns, and you just can't find that lead. But what is a lead investor? A lead investor is typically someone who's going to invest 20 to 50% of a fundraising round. They're going to set up the terms for the deal because they're writing the biggest check. They're going to negotiate hard with you. You're going to spend a lot of time going through all the details of your investment document and shareholder rights documents to make sure they're comfortable. And then once it's set, it's set. All the other investors will need to sign on to those terms. You may be able to get a side letter if you need like some more investor information rights or whatnot, but typically the lead is going to set the terms and every other investor is going to follow them. A lead might take a board seat and help run the company, or assign the board seat to someone who's a friend of their firm who can really make an impact. And then they're going to be super engaged on the next round of funding, hopefully, and they're going to pull all their resources and help you close that round. They might even go out and help you pitch or make pitches for you. You got to nail your timing to help close a round, right? You either need to have, you're going to be strongest from a negotiating position if you have cash in the bank. Maybe you are nearing cash flow positive and you don't really need to raise the money. You can continue on as is, or you've hit some milestone or you're about to hit a milestone that's going to change your valuation, right? And it gives you, again, stronger foundation and footing on which to mark your valuation off of. Whether that's $26 per user is how your companies in your sector are valued, or 13 times EBITDA, or 3.5 or to 5 times sales, right? So understand where you are and nail your timing. Reason I bring this up because it is so important to make sure time is on your side. If you're going to run out of capital in a month, you probably should have started raising about 5 months ago. So avoid the cash crunch as much as possible. Gives you confidence, gives you more options when you're raising around. Have a good and well-prepared due diligence list and a data room. This is something that we focus on in the accelerator, and I talked about assignments as part of the weekly program. These assignments complete this due diligence checklist. And understand the timeline. You should be budgeting 4 to 6 months or more, right, to close these rounds. And sometimes, like with Apex, who closed a Series Seed round just recently, 1.67 million. You've got investors who are bought in, 730, Wellcan Capital, Silverleaf, Panther. They're nailing their traction. They're growing, and they can turn around in 3 to 5 months. And but sometimes when you aim for the stars, it takes longer. FlowHub raised 23 million, a significant sum, and capital that should enable them to achieve their vision and cash flow positiveness of the business and become dominant in their market. This deal took a long time. I won't tell you how long, but it took a long time. And you never know, because those investors need to part with that capital. They're going to do a lot of due diligence for big investments. You just got to understand that it's going to take time, and make sure you manage your stress, manage your team, and manage your financials to make sure you're not in a point where you're going to be pinched. Know your comps, and comps are an interesting thing in the cannabis industry. You look down this list, and I'd be hard pressed to find any one of these companies that would be able to raise this money today. A big part of raising capital is timing, and timing when investors are ready to invest, and understanding that, and understanding also what the signals are and signs are when investors are not going to be ready to invest. Right? We talked a little bit about the Canadian LPs and the publicly traded stocks in the United States down 20, 40, 50, 80% from their highs. That definitely puts sort of chill on investors. It may not be logical. It may not be what you want to hear or know, but it is what it is. And it'd be smart not to peg your valuation off the valuations at which these companies raise capital, because those valuations are gone. And then the last thing in any negotiation, you as an entrepreneur raising capital from a company, or even if you in the future when you're selling your business, understand the importance of the LOI, and that you have the most value and the most leverage when you're raising capital at the point of the letter of intent, which is an early step in the process, right? It is sort of defining at a very high level what the key economics and terms will be as part of a investment or a sale. You have the most, as an entrepreneur, you have the most leverage at this point. Try to lock in as much as you possibly can, because again, the longer a due diligence process goes on, the more opportunities open up for an investor to find something to say no. So make sure you cut a good deal at the LOI stage. All right, and as an entrepreneur, target market standard dilution, which is about 20% when you're raising capital. It's always a signal when we speak to teams if they are giving up, planning to raise money at a valuation that is only going to result in 10% dilution or 5% dilution, or an entrepreneur is raising capital at a valuation that's going to result in 30 or 40 or 50, God forbid, dilution. Market standard is 20. That's where you should aim. And anything above and below will be impacted by the traction you have, the success you're seeing, or if you're on the verge of a big milestone or whatnot, like we talked before. So let's open up the floor now for questions. I've got my little chat room open. Can you revisit the due diligence checklist? Absolutely. So let's take a look at that. So this is just, this is just a snapshot of the due diligence checklist. But what this is the sort of outline of a data room. This is an outline of the things that investors will want to see or will most likely ask about. Obviously, there's basic documents, formation documents, IP assignment. You've got an attorney, you've got an accountant, you've got a pro forma, right? You have resumes or links to all the LinkedIn profiles of your key team members. You have a plan for the organization development. So you got an org chart, right? You know who does what, right? And all this may change over time, but at least what it shows investors is you're very thoughtful and you understand what their needs are when they're trying to figure out if they're going to make this investment or not. So the due diligence checklist, we work on it in the accelerator program from day one to up to and through the time of our investor previews. So it's a great sort of outline for building up what's going to be asked for from investors. Okay. Any other questions? We got a lot of people on. Please do put in there. Okay. What would you recommend to a startup that has a proprietary intellectual property for a flower product that would need far more than your company funds to make it to 16 months? It may not be right for us. We're not investing in businesses that touch the plant, like marijuana and high THC businesses. So that's something very unique to us. And so it might be right for another investor. What would my recommendation be? To work on that IP, try to get as much complete as possible. Research businesses are often, it's a little bit challenging for some investors to get around. So you got to find the right investors who love what you're doing and are very focused on IP and flower. It's challenging. I'll be honest with you. Hardware is also challenging. It takes a lot of capital. You got molds you got to produce these hardware products. They're expensive, hundreds of thousands of dollars. When you compare that to a software business that can change a few lines of codes, completely change their product, it's risk, right? There's perception of lower risk with software and higher risk with hardware companies. Some good questions here. How is the investment environment softening with regard to willingness to invest in ancillary startups? Are more investors interested in non-cannabis touching companies? Or are they staying away from Schedule I federal law to come online? So what I'd say is we've seen a lot of the cannabis VC funds move away from early stage and focus on growth stage companies. It's frustrating because they all started with early stage. Now they're moving on. They want to see more traction. They want to see more market development. Maybe they made some investments that didn't go well. Good ideas, good teams, but without the traction to prove product market fit. So, understandably, they want to lower the risk, and with valuations coming down in the public markets, they can push down valuations even for growth stage companies, so they can still get good economics in their investments, good valuations. And there's more capital coming into the industry. There's more capital available, but it seems like there's, and at least for the VC funds, there's more money, larger checks going into fewer deals. And that's a trend we've seen in other sectors, high tech, healthcare, just over the last couple of years, more money into bigger deals and fewer of those. Okay, let's see. Are they investors interested in non-cannabis touching companies? Yeah, there's investors coming in that are interested in everything. It's just about understanding who they are, what they want to do, and then, connecting with them. So, team spends a fair amount of our time talking to and profiling investors to make sure that we understand their needs, and that if they're looking to do deals and precision agriculture, we're making the introductions to our teams. Are they staying away until Schedule I federal law? Yes. That's been going on since the beginning of all of this. When we see federal legalization, we will see a rush of capital into the U.S. cannabis industry, much like what we saw happen up in Canada. The thing that will be different is that in the United States, there will be a massive target addressable market, whereas in Canada, the target addressable market is the equivalent of California, which is nothing to shake a stick at, but it is still significantly smaller than the market in the United States. Yes, there is talk of international opportunities, global expansion. I question if there's really a there, or if it's just sort of hand waving. Question from Zach. Is it necessary for all of the co-founders to be full-time before applying? No, that's not required. But once we make our investment, we want the core of the team, at least two of the co-founders, to be part of the program, full-time in Boulder. And hopefully that's understandable, right? Because investment, right? And this is another piece of advice for entrepreneurs. If you're raising capital, you got to be committed. Entrepreneurship is not a part-time adventure. Investors shy away from teams that are doing it on nights and weekends. It's just super high risk. Something at the job could change, and then you got to dive in. You don't have time for now your investor-backed business, and that's very, very frustrating for someone who is an investor who's taken their hard-earned capital and handed it to you with a shared vision for success and building a business. In addition to another question from Lolita, in addition to crowdfunding, what investment sources do you recommend for CPG companies that do touch THC? Well, I think you got to start out with angels and angel groups, and then move on to family offices, hopefully, or cannabis-focused VC funds. Just don't get ahead of yourself. Don't get ahead of your skis. So you're going to crash down the road. Make sure that you're following a sort of the well-worn path of fundraising. Once you skew off that well-worn path, you put yourself at risk for failure or down rounds and bad stuff. So could you provide a broad stroke picture of what an early stage angel investor deal might look like? Maybe what we as a startup should look at for. Okay, great question, Brad. So what's an early seed angel investor deal might look like? Let's see if we can go back to one of those charts. So an early stage seed investor, they're often writing 25, 50K checks into different companies. They're looking to diversify. They know they're coming in at a high risk time early. And so they want to mitigate risk by diversifying their portfolio. Certainly that's the way we approach it. Often they a seed fund will have deep market knowledge because of a volume of deals are going to look like. That's, again, we have a lot of market knowledge of the understanding of the nuance and the subtlety of the market. So we use that to our advantage when we're making investments. They have strong strategic usefulness, meaning they can help you with strategy. They can help you work through the thousand of questions you're going to have as you're working and building this business. Discipline, if they're making a lot of small investments, they got to be gunslingers to some degree. So they may be very disciplined, and they sort of put that out ahead of them, but then they might go into a deal willy-nilly, or just because they see something that is a good deal, or they can have an advantage. Their primary fear is missing out on the next unicorn. And I think one of the sales pitches you need to give to them is a fear of missing out. Train's leaving the station. We're getting this up, and you can come in right now at a $2.5 million valuation, or you can come in 8 months when we're raising at a $5 million valuation, right? So time's now. They might be but for the seed round, you might be raising $750,000 at a $2.5 million valuation, or valuation cap on a convertible note or a safe. So that's typically what we see. Bob, I think, or Brad suggested to Zach that you look at the Y Combinator safe note. I think that's a good place to start. You need to be aware of what the safe notes look like, but I know that a lot of investors, at least in the cannabis industry, don't like them at all compared to a convertible note. That is because a convertible note operates essentially the same, but minus the interest, not good for the investor. Convertible notes debt until it converts into equity. That means it is at the top of the liquidity stack. A safe doesn't have those protections as well. Safes are much more popular on the West Coast and Silicon Valley, but not really that popular anywhere else. So I would encourage you, Zach, and Brad to dig into convertible notes as well. Great. Let's see. Do we have any more questions? I see. I don't see any here. Trying to think. I'll put this back up. Very important to understand that the investor community is diverse. You'll see that some of these investors, like Salveo, are in seed stage, in the growth VC stage, right? You'll see, you're going to see companies like Poseidon in the growth and late stage. So they occupied early stage and seed near the beginning of their time as a fund, and that's changed. And that's what we're also seeing a lot of as well as, like I said, investment funds that started out in seed moving towards growth and later stage to sort of balance out their. And also, when they're raising new funds, they sort of want to raise larger stores of capital, and that will open up their ability to invest in later stages at higher valuations. Oh, we got a question here. What other points of knowledge should we know about investors? You mentioned they don't like safes. They want to see traction or shine back from seed. Any other bits of information that could be helpful? Brian, we've got a lot. I mean, we live and breathe this every day. For every single investment fund on this list, we know when they want to invest, how they want to invest, where they've invested before, how they approach due diligence. Are they lead? Do they not want to do lead? They want to follow? You know, how are they going to step up or back away? So we spend a lot of time understanding, like Altitude Investments, they're focusing their next fund on Europe, right? So they made a lot of investments in the US. Now they're going to Europe. They're going to try to capitalize on the growth of those European markets. That's just the way they are, right? Yeah, I think there's a lot to be gained from our knowledge of these investors. But you know, at the end of the day, if you can communicate value to an investor by sort of walking in their shoes and doing analysis on your company from their perspective, you're going to be in a much better position to successfully raise capital than others. And we do spend a lot of time if with our teams in the accelerator trying to help with that if they plan to raise capital. All of this stuff, they're going to help increase your chances of closing your deal. You know, but I'd say just be realistic. A good deal is a deal that, you know, maybe is a good deal for all, is a deal that you walk away from as an entrepreneur feeling like, you know what, you had to give up something. It wasn't all in your favor, but it's something you can live with down the line. A question here, will you be running an incubator in 2020? We're focused fully right now on our accelerator that is starting in January 13th. We have raised additional capital and deployed money into companies that don't fit the accelerator. Most companies, early stage companies do. We have yet to have a team in that doesn't get a lot of value from the program and helps fill in the gaps that they have that were keeping them from being successful in the past. We recently had an entrepreneur, four-time startup CEO, came into the program, and I remember him coming to me the day right after the session we did on valuation and calculating valuation. He said, if I only knew, you know, 3 of my 4 startups probably would have succeeded instead of none of them having been successful. You know, no one's perfect. No one has all the answers. And our job at the accelerator is to accelerate your development, help you fill in the gaps, and help you be successful in whatever possible way that we can. So these have been great questions. I want to thank everybody for signing in and joining us here to talk about raising capital in the industry. Slide I'm going to go back to right here is that we are, you know, currently, you know, our application is open, and we are actively reviewing these deals. So I'd encourage you, if you're interested, to apply, get in touch with us, because now is the time to be launching a business in the cannabis industry. And entrepreneurship can be a lonely and long journey, and it's much better to embark on that journey with partners who share your vision and goals. And that's what we're looking to do. So with that, I want to thank everyone for attending. And if you have any more questions, feel free to reach out to us. with those. Okay. Thank you very much.